Hi there. In this video, we explain how UK businesses can claim qualifying pre-trading expenses and what HMRC allows under the 2026 rules.
Every year, new business owners throw away thousands of pounds in legal tax relief. They discard old receipts, assuming that because their business wasn't officially open yet, those early setup costs don't count. Hello, I'm from My Tax Accountant. Today, we're looking at exactly how to reclaim up to 7 years of pre-trading costs under the newly updated 2026 UK tax rules. We will walk through how to audit your past expenses, navigate the new 2026 capital allowance rules, and secure your maximum tax relief blueprint. Conducting a proactive historical audit transforms those out-of-pocket setup costs into a day-one cash flow advantage for your new venture. Step 1 is pinning down the exact legal start date of your business. You cannot accurately calculate your timeline without this anchor. The recent Putney Power Tribunal ruling clarified how HMRC defines the commencement of a trade. The ruling focused heavily on a business's actual operational capabilities, rather than its preparatory actions. Simply incorporating at Companies House or printing business cards does not trigger your start date. The clock starts only when your business is actually capable of providing its goods or services to customers. This timeline shows how the rule works. Once you establish your day one marker, you can legally look back up to 7 years to gather your eligible income and corporation tax costs. Establishing an accurate, legally defensible start date dictates exactly which historical costs are permissible, saving your entire claim from HMRC rejection. Step 2 separates day-to-day revenue expenses from long-term capital assets. To enter the revenue bucket as a day one expense, costs like web hosting and accountancy fees must be incurred strictly for business. Under 2026 guidelines, relevant training costs now also drop straight into this bucket. Step 3 addresses the items in your capital bucket. These assets are not claimed as standard pre-trading relief, but are instead processed through the capital allowances regime. This illustrates the new 40% first-year allowance for 2026. On £10,000 of qualifying pre-trading capital expenditure, you immediately deduct £4,000 in year 1. The remaining balance enters the main pool for a 14% writing down allowance in subsequent years. Correct leading. Step 4 involves navigating the significantly stricter time limits for reclaiming pre-registration VAT, which differ completely from the rules for income tax. This timeline shows the strict 4-year look-back window for reclaiming VAT, like laptops and vans. An in-stock rule applies. Goods must be owned and unconsumed on your VAT registration date. Laptops you still use qualify. Burned petrol does not. For services, such as rent or legal fees, the look-back window shrinks drastically to just 6 months prior to registration. Step 5 is recording and reporting all of these calculations using the correct 2026 digital infrastructure. The April 2026 Making Tax Digital mandate requires sole traders earning over £50,000 to input these costs as day one digital adjustments. Limited companies face a similar process using specific workarounds on the CT 600 form. Applying precise VAT time constraints and utilizing the correct digital reporting protocols ensures your generated tax shield survives strict HMRC compliance audits. We've covered pinpointing your start date, sifting revenue from capital, applying the 2026 capital allowances, and maximizing your VAT recovery. Meticulous historical record keeping is the requirement for a tax-efficient business launch. Remember, this information is educational. Tax laws are complex and subject to change. To ensure your 2026 pre-trading claims are filed perfectly, contact My Tax Accountant. Call, email, or visit our website for expert assistance. Professional oversight guarantees your past expenses transform into immediate, compliant business capital.